Hello, Paul Gerard from Price Accounting Services. In this video today, we're going to talk about the new rules for superannuation deductions. Okay, so since the 1st of July 2017, all the old rules about superannuation contributions and tax deductibility, they've changed. Okay, so prior to the 30th of June 2017, in order to make a contribution to super, you needed to be self-employed or be employed with an employer, but your employment income had to represent less than 10% of your total income. So it was pretty tough for some people to really top up their contributions. For example, they were confined to their employer amounts and that was it, unless they salary sacrifice. So let's walk through from the 1st of July 2017, so in other words we're talking about the 2018 tax year and onwards. Let's talk about the tax benefits, because if you miss this, you might actually be missing the most valuable tax deduction and way to park your savings into super available. So I want to walk you through the process. Okay, so 2018 tax year, most employees get their super guarantee contributions, the 9.5% from their employer as a contribution. And for most people, that's going to reflect less than $25,000. Okay. However, your entitlement to a tax deduction for all taxpayers up to the relevant ages is $25,000 a year. So if you're contributing only 9.5% and you're not contributing up to the $25,000, there may be a tax benefit you're missing. So I want to explain what that is, and there's a couple of different ways you can approach it. Okay, now the first way you can approach it is through what's called salary sacrifice. Salary sacrifice is where you turn around and you say to your employer, for example, let's say you earn $120,000 a year. And let's say you want to add an extra $10,000 to your contributions. You approach your employer and you say, hey, can I just contribute an extra $10,000 before tax to super? The employer says, no problem. So the employer then changes the contribution amount up by $10,000 and drops your salary by $10,000. Now it might be a bonus or something like that. However it works, just how it occurs. So let's say they drop your salary down. That's the salary sacrifice proportion. So what happens is you're getting the tax benefit of not including that $10,000 in your assessable income. So the employer will claim a tax deduction and you end up with extra money being taxed in the super fund. Now it's important to remember this. Contributions, what we call concessional contributions into super, in other words the amount your employer contributed, are taxed at 15 cents in the dollar. But most taxpayers are in that 34 to 39 cent tax bracket, okay? So for every dollar you put into super above the employer's mandatory amount, you may only pay 15 cents in the dollar tax instead of 39. So you think of the tax saving can be as much as almost 25%. That's going to be fairly generous. Now let's use an example of somebody who, let's say, is getting a $15,000 bonus. Let's say it's myself. I'm getting a $15,000 bonus, and instead of taking it in cash, which then means I'd get taxed at 39 cents in the dollar, I choose to have the employer contribute that to super. So instead of 39 cents, I pay 15 cents in the dollar. Tax saving, okay? But not only that, you're getting the benefit of that compounding growth that's going to flow through into your super. So a person like myself in 50s, I've got another 10, 15 years of working life, whatever it might be, and I do this year, next year, and so forth. So at the end of 10 years, there's going to be $150,000 plus the accumulated growth and earnings on that, less only a very low tax rate. So it's a good way of making it work. That's one way. The other way is when you make personal contributions and intend to claim a tax deduction. So that's now an option for nearly all taxpayers, particularly those who work. So how does that work? Well, let's say you inherit some money or you win money on Powerball. I don't know what you do, but you've got some money set aside and you think, I'm going to put that aside to super. So the process is this. So this is not if you use your employer, this is a non-employer way to do it. So if my employer is already contributing, say, $10,000 or $15,000 to my super, I'm going to add this other $10,000, okay? It's important I don't go over the $25,000 cap, of course, because then we're going to get into a penalty area. But we're staying under the $25,000, so I'm going to talk about this $10,000 amount. So $10,000, you contribute that to your super fund prior to the 30th of June. Then there's a very key and important process that follows this. When a fund receives a contribution, it doesn't always allocate it as a employee tax contribution. It's not quite sure whether it's your own savings and you're just putting in. So it could be a non-concessional contribution, i.e. extra money you've set aside that doesn't count toward that $25,000. So for example, if let's say my great-great-grandmother died tomorrow, and she's already dead, but let's assume she did it again, and this time around she decided to leave me a generous amount of $100,000, and I have no further use for it other, for example, I've got no mortgage or debt, I don't have a need for the $100,000, I can choose to put it into super. Now that might be what's called a non-concessional contribution, so it's not taxed. Okay, so we're always talking about concessional contributions when we talk about a tax return. So that $10,000, you make the contribution, but then you need to tell the fund that you're claiming a tax deduction for it. And there's a specific process in the Tax Act under section 290-170 in the Tax Act for those who love the technical side of things. And it contains a deduction notice rule. And it says that the taxpayer must write to the fund and advise the amount that they intend to claim a tax deduction for. So what you do, ring your fund. Tell them, hey guys, I made a contribution in May or June of 2017. I want to claim a tax deduction. They will then send you a form and you need to complete that form and say, I'm going to claim a tax deduction of $10,000. Then once you submit that to them, they will write back to you. And this is very important. They will write back and confirm that you have an eligible deduction of $10,000. Without that notice exchange, you do not have a tax deduction. And worst of all, the tax office take a really hard approach on it because the wording in the law says you must have the notice prior to lodgement of a return, okay? So if you don't have that notice and you lodge your return and the tax office ring you and they say, hey, we don't have a deduction notice on file because they know your contributions. This doesn't look right. Can you send us a copy of the deduction notice? And so you ring up the fund and they go, what are you talking about? They want this deduction notice. And they say, well, you haven't done it yet. Oh, we'll issue one. So they issue the new letter and it's dated today's date. It's not dated yesterday's date or the day before. You've already lodged your return. So what the tax office will do is disallow your deduction and impose a penalty perhaps. So it's really important if you're claiming a tax deduction for super contributions that it is eligible. So make sure you've got that deduction notice requirement met. We're going to ask for it. We will not lodge a tax return for a D12 deduction claim without that notice on our file on the day we lodge. So that's your protection using a tax agent and also a tax agent who knows what they're doing in super. And we get that through our related entity, Price Financial Intelligence, because we handle hundreds of clients' superannuation affairs. So we know finance and we know tax pretty well. So I hope that helps explain the new regime for tax deductions, and we look forward to seeing you soon. Cheers, bye.